Welcome back. Today we are breaking down one of the most iconic names in the stock market, Coca-Cola, ticker KO. With 64 consecutive years of dividend increases and a fresh earnings report on the horizon, is this defensive giant still a buy at today's prices? Let's dive into the data. Coca-Cola is heading into a pivotal moment. The company is scheduled to report Q1 2026 earnings on April 28th. Wall Street is looking for revenue of around $12.24 billion and an EPS of $0.81, a solid jump from last year's $0.73. This is also a major milestone as it marks the first earnings call under new CEO Henrique Braun. Investors are watching closely for his signals on capital allocation. On the growth side, the momentum is real. Coke recently renewed its global partnership with the NBA, bringing Sprite back to the forefront, and they are gearing up for a massive marketing blitz for the 2026 FIFA World Cup. Now, let's talk valuation. KO is currently trading around $76. With a trailing EPS of $3.05, we are looking at a PE ratio of about 25 times. Looking forward, the PV drops slightly to 23.5 times, based on an expected 2026 EPS of $3.32. Is it a bargain? Not exactly. Guru Focus sets the intrinsic fair value at $68.40, suggesting the stock might be about 11% overvalued right now. However, Morningstar views the stock as fairly valued, noting that investors are often willing to pay a premium for that legendary brand moat. The price-to-book ratio stands at 10.18, which is consistent with its long-term historical median. What does the big money think? The consensus is a strong buy. Out of 15 recent analyst ratings, 14 are buys. UBS is the most bullish with a $90 target. Morgan Stanley and Wells Fargo are close behind at $87, citing Coca-Cola's incredible pricing power and earnings visibility. Jefferies recently nudged their target down slightly to $88, purely due to geopolitical risks in the Middle East affecting supply chains. JPMorgan holds an $83 target, while Goldman Sachs remains the cautious outlier with a hold rating. Overall, the average price target sits at $85.64, suggesting about a 12% upside from current levels. The bull case for KO rests on stability. Coke Zero Sugar continues to drive volume, and expansion into emerging markets helps offset slower growth in developed countries. Plus, the dividend yield remains attractive at 2.8%, with the quarterly payout recently bumped up to $0.53. Of course, it's not without risk. Currency fluctuations, rising input costs, and a lingering tax dispute with the IRS are the main headwinds to watch. You aren't buying KO for explosive 100% gains. You're buying it for reliable, compounding growth. Bottom line, Coca-Cola is a fairly valued defensive anchor with steady dividends and strong analyst backing. All eyes are on the April 28th earnings call. If you enjoyed this breakdown, hit like and subscribe to Fair Value Study.